Remember, in accounting, we have an accounting equation. And in accounting equation, we say asset equals to liability plus equity. Asset is something that we get future benefit out of that. It gives us long-term future benefit. Asset might be cash, might be a building, might be inventory, supplies, machinery, equipment, accounts receivable, note receivable, any type of investment that you invest somewhere, like invest in bonds. Those are all type of assets. Intangible assets, let's say, for example, copyright, patent, goodwill, franchise right. Those are all type of assets that you might have. So let's look at the equity section. Liabilities are, I remember I got the question in regards to liability. So liability is something that you owe. Why do you owe something to someone? Because that organization or that person provided you a type of service and you got the benefit out of that service. And since you use that benefit, now you are liable to pay for it. So a liability comes from where you use a benefit. That benefit becomes an expense. Therefore, you are liable to pay for that expense. Equity is a little bit different story. So what is equity? Equity might be, so let me delete this too. So equity, if I draw a line here and I make it like a double line like that. So what is equity? Equity is, if it's a corporation, it's common stock, right? That might be a equity. If it's a sole proprietorship, you call it owner's capital. But if it's a corporation, you call it common stock. But common stock minus what? Common stock minus, that's a minus what? Minus dividend. What is dividend? So dividend is something that the corporation pay to the shareholder to share the income of the corporation with shareholders. We call it dividend. We don't call it dividend expense, but we just call it dividend. So dividend, shareholders get dividend. So if I have, let's say, what was that? Citigroup. Let's say, I believe a few days ago, I got Citigroup stock. And because of that, I got, in my portfolio, I got, what, $12 something from Citigroup. That's how you get dividend from it. From Citigroup, let's say. That's portion of their profit quarterly format. Every quarter I get some dividend. So dividend, it's a minus thing, because when the corporation is paying dividend, then that equity of the corporation will go lower. It has a negative impact to the equity. That's why we say common stock minus dividend. Okay. Then after dividend, we call it plus. Plus what? Plus revenue. So revenue will be a portion of the income that will increase. It's an income that is increasing your equity. So there's two ways looks like you can increase your equity. You can increase your equity if you issue stock, common stock, and you can increase your equity if you have revenue. So revenue and common stock is increasing equity. Common stock is outsourced. It's coming from outside, from shareholders to increase equity. But revenue is generated from inside of corporation. So that comes from inside operation to increase the equity. But you cannot only increase revenue, because when you want to increase revenue, you need to have some type of expenses. So therefore, the expenses will be your so-called cost of revenue. Anytime you want to create revenue, you need to spend money. You have to rent a place, you have to pay utilities, you have to pay insurance expense, you have to pay for supplies, you have to pay for, I don't know, so-called wages for employees. So you pay all those in order to generate revenue, okay? And two ways to increase your equity is common stock and revenue. Two ways that your equity goes down, it's either paying dividend to your shareholders at the end of each quarter or end of a year, or paying expenses at a daily basis, monthly basis. All those expenses will be reducing equity. So in this case, you remember we issued stock for $350,000. So the stock that you issued, that's you receive cash. So that is equals to that cash that you received. So here we go. And as you see, your assets is increasing, okay? And your equity, common stock, is also increasing. So here we go, equals to common stock, enter. So this is the accounting equation, asset equals liability plus equity, right? And as you see, by doing a double entry, I keep this equation balanced, right? So asset equals to liability plus equity, right? So you don't want to break this equation. In order to not to break that equation, whatever you record, you have to do it twice. We call it double entry, okay? So in this case, double entry for first transaction happens. You need to double entry, we call it either debit or credit. It's debit credit just means nothing, it's just a name. It's absolutely has no meaning. It might be another stupid name, but they chose debit and credit. Doesn't mean, oh, you have a debit card or credit card, I know what it means. No, you don't. This is just meaningless. Just two names. Instead of debit, they could have called it left side, right. Instead of credit, they could have called it right side. But instead of left side, right side, they chose a name, debit and credit. So we have to do double entry, as you see. This is the reason, in order to keep this equation going. So I got the first transaction done, and then you click Save and New. Let's say you are in QuickBooks. You click Save and New, and that Save and New means you are saving somewhere this transaction. Where are you saving? In the related T account. Where are those T accounts located? T accounts are located in the general ledger. So if you go down, if you have a paper copy, it's on page 3. So as you see, this is your T account, okay? And T accounts, that's what we call it, general ledger here. General ledger, cool. So what is general ledger? A bunch of T accounts. Every T account has a name and has a number, okay? Where are those numbers coming from? Here, coming from here. Every asset starts with 1, okay? Liability starts with 2. Equity, common stock, starts with 3. Dividend, same thing, starts with 3. Revenue starts with 4. Expenses starts with 5 or 6. The reason I say 5 or 6, because if you have cost of goods sold, starts with 5, okay? So those are account numbers. Account numbers. Okay. So account numbers starts with 1 for asset, 2 for liability, 3 for common stock. Dividend is the same thing, 3. And revenue starts with 4, and expenses start with 6. So one thing, what is revenue? Revenue minus expense. Revenue minus expense technically is what? Net income, right? Is the net income of the corporation. Revenue minus expenses is net income. If it's revenue too little and the expense is too much, then it becomes net loss. But in this situation, it's net income, assuming revenue is bigger than expenses. Okay, so what is revenue minus expense, which is net income, plus dividend? Or I mean minus dividend. So net income minus dividend, that gives you the retained earnings. Okay, so retained earnings covers this part. Retained earnings is that part. Retained earnings. Net income is just revenue minus expense. So net income is that location. Revenue minus expense is net income. And if it's a brand new company, right, retained earning is 0. So brand new company, retained earning, leftover profit after paying dividends is 0 because it just started. Then beginning 0 plus net income, which is that area, minus dividend, you see dividend is minus dividend becomes retained earning at the end of the year. So beginning of the year, retained earning, let's say brand new company, 0, plus net income that company creates, minus dividend that company pays to the shareholders becomes retained earning. What is retained earning? Retained earning is leftover profit that the company can keep it down the road and spend it to do something with it. Buy new equipment, investing more, buying building, or paying more dividend in future years, whatever they want to do. Or doing, let's say, more research and development, those type of things. So let's say Apple company didn't pay dividend for many years, right? And they spent on R&D, research and development. And after that, many years later, down the road, they came up with iPhone, iPad, and all those good, cool stuff. And those cool stuff became a very good source of creating profit. Now, Apple company is the most expensive type of corporation in the whole planet. And recently also, just today, Apple did a stock split. So whatever the stock price of the Apple was, it did 4-for-1 stock split. 4-for-1 stock split, that means, let's say the stock price was 400 starting today. If you had 1 stock, all of a sudden you have 4 stock, but instead of valuing $400 each stock will be worth $100. So it's a stock split. Tesla did also stock split today, 5-for-1. So whatever it was priced before, let's say $2,200, now you get 5 stock, but worth like $440, let's say. Okay. So let's see do we have any questions so far from anyone? No. Okay, let's continue. So far we recorded 1 transaction and we posted to the general ledger as you see. So how much cash do we have? As you see, 350. How much common stock we have? 350. Okay. Now let's do another transaction. In January, we purchased equipment for $13,000. Not 13, it's 48. So I changed it. So let's fix this. So it's 48. okay, with a residual value of 3,000. So here we go. So we purchased the equipment 48. This is the number 48, and the residual value is 3,000. So this is the kind of sentence description, but this is the actual numbers right there. So good for us. We bought an equipment, looks like. Congratulations. So how do you buy an equipment? Equipment is an asset, agree? So when you get an asset, where do you put it? Remember last time I said, when you get an asset, either $10 or $100 or an equipment or a building or whatever else, you put it in your pocket, right? Close to you. So you can stand right here and say, wait a moment, I got an equipment, so that's an asset. I'm gonna put it in my pocket. And when I'm equipment. Okay, so where I'm standing from here, the closest place in my pocket is close to me, right? The closest place is right here. From here that I'm standing next to equipment, when I get an equipment, I put it in my pocket. When I get the cash, I put it in my pocket. My pocket, why do I put it in my pocket? Because it's close to me. So which one is close to me, debit or credit? You remember that funny story I told you last time? And this is just between me and you. Don't tell to anyone because it looks stupid. But anyway, it works. So it's a good way to remember things. So from here that I'm standing next to equipment, I'm gonna put it in my pocket, which is close to me, which is debit is the closest place to me. So I'm gonna put it there, $48,000, okay? But remember, do we type? No, right? Because this is in Excel. You don't type in Excel, right? So what do? You say equals to source document. This is the source document. You see that? Enter. So numbers are coming from the source. You don't type in Excel unless there's no other choice. So this is the equipment, $48,000. Watch here. Here I typed. Why? Because I just created this. So there's no other choice, so I type it. But after that, I don't type anymore. Okay. So now this box, if something is debit, swear to God, something is credit, right? We have to do double entry, right? So how did we pay for this? Did we borrow? If it's borrowing, we say note payable. If you pay partially, like down payment, you say, let's say $30,000 down payment, you say $30,000 cash. Let's say for example, just to learn. Let's say you pay $30,000 down payment. So that's cash, okay? That's cash. So cash goes out of your pocket, remember? Cash goes out of my pocket, far away. Here we go, far away. From where I'm standing next to equipment, cash goes out of my pocket, far away, which is credit. But that's not enough because the other side, debit side, is 48. So here, right, the difference will be what? The difference will be equals to that box minus this box, enter. That's the difference, okay? And that will be, let's say, note payable. But because it's a credit, so I go here and I leave some indent just to show that this is a credit. We do this indent specifically in an accounting class to show that what is debit, what is credit. In QuickBooks, let's say if you are doing QuickBooks, you don't need to indent anything, you just enter it. In QuickBooks, there's a box in here, you click that box and chart of account will drop down, chart of account will open. You choose your account, let's say note payable. In this case, you buy this equipment by partially paying a down payment, partially borrowing. But here it doesn't say anything. Here it says we straightforward, we bought equipment. That means you purchased. There is no down payment or borrowing any description in here. So just to keep it a little bit easier, we can say, okay, so looks like we didn't borrow anything. So let's delete that. Let's delete that. So this is equal to actually 48 and enter, right? So this is the equipment you purchased. And just to see the situation, what's going on in here. So here you got equipment, congratulations. So equals to 48, enter, right? And you pay cash. So your asset goes up, but asset goes down in the same time. So here you say minus equals to minus that box, enter. So there you go. So now, as you see, your asset goes up. In the same time, your asset goes down. And no matter what, your equation is at this moment still same, equal. You didn't break the equation. But remember, you need to click Save and New, right? Let's say you are in QuickBooks, right? Save and New. So click Save and New if you are in QuickBooks, but unfortunately you are not. So by doing this right now, as we do, you are learning what's going on when you actually do so-called in QuickBooks Save and New. You understand what's going on. So I click Save and New if I'm on QuickBooks, and this is what's gonna happen. It's gonna go everything in here. General ledger. Okay, but cash this time goes out of my pocket, right? So this box equals to the cash credit, which is here. Enter, as you see. And equipment should be debit. Here. Do I have an equipment here? Do you see any? Huh? No. Okay, so create one. So here we go. Equipment is right there. But equipment needs an account number. Okay, so what's the account number for equipment? Equipment is fixed asset, it's not liquid. I know it starts with 1, but you don't say, let's say 120, because the 120 or 130 or 125 or 115 or 135, those belongs to more liquid assets. Less liquid fixed asset goes more at the bottom of the numbers, like 170, 180, 190, those type of areas. So in order just to see an idea, I look in the worksheet. I want to see what account number I provided here. Here, I said equipment 167. Make sense? So I'm going to use that number so it's kind of matching. So equipment will be account number 167. There you go. Cool? Okay, so now I want to make this a good box, so let me see here. Okay, so now equipment, it's debit, right? So I go on the debit side, left-hand side, and I say equals to, I go up to my journal entry and click on the equipment debit side, right? And enter. So all of a sudden my equipment now is showing what I have. So let's see how much cash I have right now. So I draw a line. I'm gonna make it like Excel, right? So I like to go here, and choose top and double bottom border, that one. You see that? So now here I say, how much do I have? I say equals to that box plus that box plus that plus that plus that plus that, right? Whatever it's here, it's a plus. Then minus that, minus that, minus, 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 enter. So let's see, it says false. I put equal. Oops. Because I'm using this laptop. In laptop, every time I want to say plus, I have to keep shift. In my desktop computer, the keyboard is more sophisticated. I don't have to do that. That's the bad thing about laptop. Let's see. I don't know what happened now. There you go. Okay, so now you see how much cash do I have? 302. Because my debit sides, whatever it is, minus my credit sides, whatever it might be, it will be at this moment 302. Okay. Let's see if there is any question for me. No. Okay. Okay, so that's what it is. So now my T account is updated and my accounting equation is balanced, as you see, and I'm doing my journal entry, right? Let's do one more. So here we go. On November, we paid for utility bills, how much? 12,000. Okay, so you paid. That means cash goes in your pocket or out of your pocket? Obviously out of your pocket, right? So remember, credit is the second line. I want to do easy way. So I know cash goes out of my pocket. So I go to the second line. I go few indent, and then I say, okay, cash is going out of my pocket, far away from me. How much? Here, $12,000, enter, right? That's what it is, $12,000 enter. You don't need $sign for here, just to keep it like a kind of normal general number. And I don't want also zeros, so out of my pocket. Definitely something has to be debit, so equals to my $12,000. But again, what is this, gosh? Why did I pay $12,000? Think about it. I paid for utility bills. Some students call it utility bills, but utility bills doesn't make sense. Utility bills is just a bill. But when you pay for it and when you use that utility and you have the obligation to pay for it, it becomes utility expense right away. So here we go. Utility expense. Make sense? That's what it is. It's not utility. It is utility bill because you are paying it, but moment you pay for it, moment you have the obligation to pay for it, even, it's a utility expense. So as you see, utility expense becomes $12,000, debit, and cash goes credit. So one more time, how can we make this easy? As you see, I started from the easy part. I said, let's start with cash because I know cash is going out of my pocket, definitely far away. That's $12,000 credit, and something has to be debit. No doubt about that. So all I need is just a name and utility I'm paying for utility bills. So utility expense is a very good, appropriate name. Everyone can understand it. So utility expense, now it's a $12,000. You see where the expense is? So that's where the $12,000 goes, equals to that box, enter, right? And that $12,000, it's a negative, okay? Why? Because here you see it's a negative effect in the equation. You see here, expense has a negative equation, it should be negative. That's where the negative is. Okay, but this one is a $12,000, right? So you have to have a double entry. So here we have $12,000, and in order to keep the equation going, so equals to that cash, $12,000. Enter, right? Make sense? So the reason this is negative, I don't have to say negative, but you need to understand this expense. So I can take it out for now if you like to, but just let's delete the whole thing. Equals to that box. Okay, one more time. So this is a negative impact to what? Negative impact to this area, to the equity. Here, there's a negative over there, okay? Makes sense? Negative, right there. So cash goes out of your pocket, right? So it's cash also negative, right? So let's do that. Here, on my laptop, enter. Okay, and one more time, expense has a negative impact to this, right? So your expense, yes, I know your expense is increasing. I understand that your expense is increasing. Your expense was zero a moment ago, all of a sudden is $12,000 expense, right? But your expense has a negative impact to the retained earning. And you see the negative right there. So therefore, I would like to put that negative and reflect that just like that. So cash goes also out of your pocket. That means cash is decreasing. So that means definitely a minus on the asset part. So asset is going down, and on the right-hand side in the equity area, your expenses is increasing, but it has a negative impact to the equity, and that's why it's minus, and it's showing a minus here too, so you can understand why it minuses. But again, you need to click Save and New to do another journal entry, right? So let's do that. So click Save and New if you are on QuickBooks. This one is not QuickBooks, so you have to do it manually yourself. So let's save this in the general ledger. So general ledger goes down, and cash is credit. I know that. So let's do that easy one here. Cash is credit. Enter. Okay. As you see, my cash is adjusted again. How much cash do I have? $290. But utility expense, I don't have that. So let me save that name and Control C and put it here, Control V. Control C for copy and Control V for paste. Okay. And this is the box that I would like to create. Make sure we have. Okay. Utility expense. But I need a number. What's the number for utility expense? Expense starts with 6. So 6 something. Let's look at the worksheet, see if I can have some idea. 633. You see in the worksheet, it says 633. I'm going to use that. Okay, so here, 633. There you go. So utility expense, account number 633. Good. There you go. Number. You like that? Better? Here we go. Okay. Okay, so far so good. Now let's see if there is any question for me, you believe? Anyone? You are doing good, I believe, hopefully. Let's go to do one more. In January we paid, here, number 4. In January we paid in advance for 2 years. Okay, let's talk about this advance thing. There is 2 types of accounting method in accounting method while you want to record journal entries. You have to report that in your company tax return also. When you create a company, IRS wants to know, and everyone else wants to know, what type of accounting method are you using? Cash method or accrual method? In the cash method of accounting, if you pay for something, doesn't matter if you get the benefit out of it or not. If you pay for something, it becomes expense right away. If you get cash from someone, doesn't matter if you provide any service yet or not. Since you got the cash in your pocket, it's revenue right away. Simple as that. So it's expense when you pay for it. It's revenue when you receive cash. That's cash method of accounting, which is not accurate enough. It doesn't provide you a good kind of, picture on your, revenue and expense things. It gives you good enough to do a small business. Let's say I have a small business right now, I do cash method. So I declare to the IRS that I'm doing cash method and it's a small business. IRS says no problem, let's do it. But if it's a larger corporation, it's a large business, you don't do cash method, you do accrual method. So what accrual method means? Accrual method means you record revenue when you finish the job, provide the job to your client. That's the moment that you deserve to record revenue. So if someone pays you in advance to do a job, you didn't do the job yet, that money that you received, it's a liability. You owe that money back to that person or that company because you didn't do anything yet. Let's say expense. If you pay for, let's say, rent in advance, did you move in? Did you use a benefit out of that property? No, you just paid the rent in advance for the whole year, right? So that rent that paid in advance is not rent expense yet because you didn't use any month benefit out of that property. So everything is asset, prepaid rent. You can even go back to your landlord, say, you know what? I'm not moving in at all. I just changed my mind. Just give my money back. So you get your money back. So whatever you pay, it's prepaid asset, prepaid rent, prepaid insurance. So for example, AAA, I always pay in advance. They say that's your bill, $2,000. I give them $2,000 in advance. Why? Because I don't like to pay 18% interest rate, annual interest rate. So I paid them $2,000 in advance. So that $2,000, it's a prepaid insurance. In a matter of a month or two, or even tomorrow, I can just go back to AAA. I say, you know what? I'm canceling my insurance. Give my money back. So I get my money back. So whatever I paid them, it's an asset. We call it prepaid insurance, prepaid whatever. Let's say prepaid rent. So in this case, based on that, whatever I just said, in January paid in advance rent for 2 years. Did we move in? Did we get any benefit out of this property yet? No, we just paid in advance so we can move in. So, okay, here we go. $36,000 is paid out of our pocket. In our pocket or out of our pocket? Out. So, okay, it goes out of our pocket. Definitely credit. Agree? So equals to $36,000. Right? Definitely credit. And that's cash. So I got some indent out of my pocket, cash. Simple as that. What did I get in return? Equals to that, right? So now what did I get in return? That's prepaid rent. That's an asset. So if you get, this is an asset. If you get an asset, where do you put it? In your pocket. You see, it's debit, close to you. If you lose a cash, if you give up a cash, it goes out of your pocket. So here we go. Cash is an asset, goes out of my pocket, far away, we call it credit. Agree? And if you want to show it in here, this is how it goes. So this is equals to prepaid rent, so asset goes up. And here equals to negative that box. So cash goes down. So cash goes down, huh? And asset goes down, asset goes up in the same area, left side under asset. So still the equation looks good. Make sense? The reason it shows red like this in parentheses, because I have a dollar sign. So if I make this as a dollar sign, which you don't need it, but if I make it like a dollar sign, it will show up here the way it is here. The reason I don't want to show as a dollar sign, because I just want you to understand when you work in a QuickBooks, let's say, you never put dollar sign. QuickBooks knows already it's a dollar over there, okay? So you don't need dollar in here. But the reason it's copying dollar sign, because I'm copying from here, and therefore it is kind of dollar sign thing, okay? So here you need to say Control C, Control V. So you need to click now this box if it's in QuickBooks and save it in what? In General Ledger. So let's save it in General Ledger. So here we go. So cash you paid. So definitely that equals to cash that you paid, which is that box. Enter. I don't want dollar sign here, so let me get rid of that dollar sign. Okay, so cash goes out of my pocket. This one I want to be dollar sign. This is the last part. So, and I don't want any. Okay, here we go. So now I have $254,000. Cash is reduced again, credited. But I got something in return. We call it prepaid rent, right? So let's go to that box, and I'm lazy, so I don't want to type too much. So I say equals to, then I go up and I say equals to that box, enter. So all of a sudden I have prepaid rent, okay? And we need an account number. Account number, prepaid rent. What number is that? Prepaid rent. Number. Let's look at the worksheet. I want to use that number. Prepaid rent. It's an asset. Starts with 1. So here, 125. No, sorry, 128. Okay, 128 is good. So we take that. So prepaid rent, account number is 128. Okay, and prepaid rent, now it's a debit, so equals to, go up. You see where the debit is right there, huh? Enter. Okay, just to make it less confusing, let's take the dollar sign out of that. Put it regular number. Here we go. Okay, so now I have a prepaid rent T account showing $36,000 balance. Where's my utility expense? I forgot that. Okay, no problem. Let's say equals to, I forgot that utility expense. Oh, here, enter. So as you see, now we have cash, total $254,000 available. We have common stock, $350 available. Equipment, 48. Utility expense is $12,000 so far. And we have another form of asset. We call it prepaid rent, starts with 1. And that's $36,000 balance. So all my general ledger is right now up to date, as you see, okay? And my journal entries are done, one after another. And also here, my equation is balance. So just for you to understand why we are doing all this crazy stuff, because in accounting, we have an equation. All assets should be always equals to liability plus equity. And I'm just doing that. So as of this moment, if I draw a line, right? If I draw a line here, okay? And if I add them up, so here, if you add them up, you say sum, okay? Enter. You see, that's 338. And if you do it in here, right? And here, you will see that's also 338, because if I sum it, if I go to this box, I sum it. It's 350. If I go to this box and I sum it, okay, it's minus 12. So as you see, is equal. So 350 minus 12 equals to 338. So far, my equation is perfect. So that's good for today, a little bit. So we do the rest later on. So your job is to practice this, get ready for chapter 3 and 4. We learned what is accrual basis accounting and cash basis of accounting. We learned that if we pay something that we didn't get any benefit out of it, it's not going to be an expense yet. So later on, it might be an rent expense that you need to recognize as an adjustment here, adjusting. But for now, it is not an expense whatsoever. So let's say